Receivables are valuable assets for the company, no matter accounts receivable or notes receivables. Since these receivables finally will become cash receipts, so they have value, although they are risky assets. And in business, the company can use the receivable for either secured borrowings or just sale of these receivables, just like sales of other financial assets, property, plant, equipment, same thing. In this section, I focus on the secured borrowings. So company pledge accounts receivable as collateral for a loan. These receivables are the collateral for the loan, and also entire receivable balance serve as collateral, not a specific part of the receivables. The company itself, who use these receivables as collateral, is still responsible for the collection of these receivables because it still has the title of these assets. It just uses these assets as collateral unless it transfers the title of these assets to the lender. The arrangement should be described in the footnotes. Okay, so these slides actually provide similar information as the last one. So this is what's the notes provided regarding the arrangement of pledging receivables. So usually, lenders lends an amount of money that is less than the receivable assigned by the borrower. There is a difference, which is protection, okay, to the lender. Just like when you buy a home, usually you need to have down payments, or your loan is less than the value of the house. So the difference is actually your equity, or it represents a protection to the lenders. And for this arrangement, also the lender will have an upfront charge to the borrower. And this charge is determined by the value of the receivables that pledged, and also a rate. Since this is borrowing, so the company who pledge accounts receivable will also recognize interest expense later. So let's take a look at this example. This company borrowed $500,000 from the bank. Okay, so that's amount of money it planned to borrow from the bank, and the interest 12%. This company used the receivable as collateral for this loan. The amount of receivable was $620,000, which is greater than the notes. And there's a upfront charge, finance fee equals to 1.5% of accounts receivable assigned. So this fee actually is a product of the value of accounts receivable multiplied the rate, which is usually is a lower rate, very low, 9,300. So the borrower, this company, will debit the amount of cash, which is the difference between the notes payable. That amount should be paid back. Okay, that's the loan. Actually, the amount of cash received, we should subtract the finance charge, which is an expense. So the cash received from this loan was $490,700, lower than the note itself. During the loan term, the company still in charge of the collection. This is a journal entry, has nothing to do with the bank. Okay, so the company received the cash from its customer and credit accounts receivable for $400,000. Okay, right now the company has more cash available, so it pay back the loan partially. So it pay back loan $400,000 since it's been 1 month. So the company will recognize 1 month interest expense. The interest expense is not determined by the amount of collaterals, it's determined by the principal of the notes. $500,000 multiplied annual rate, since it is 1 month, is 1/12. So 5,000 interest expense. So the actual payments should be 405,000, which is the amount paid back to the principal and the 1 month interest. Original balance of notes was 500. There are still $100,000 notes payable outstanding. After this journal entry, if we check these two tier accounts receivable originally was debit 620, collection 400, so the residual balance 220. While notes payable originally was 500, payback 400, there's still 100 outstanding. Later, when more receivables are collected, the company has more cash to pay back the residual notes payable. And the interest expense is determined by when the payment was made. Here is an example similar to the one I showed you. The amount of receivable was 140,000. This is used to determine the upfront charge, determine the finance charge expense. The amount of loan or notes payable was 100,000. The difference between the charge and notes is the cash received from this arrangement. So 2,800 is a product of 140, the balance of accounts receivable, multiply the rate of finance charge, 2%. So the answer is B.